Okay, so now we're going to cover market structure. This is probably one of the most important concepts to understand deeply and to prioritize in your learning. It is, very basic, but the basics tend to be the most important things to understand and master. Again, so market structure is just purely defined. It's highs and lows. So think of highs and lows. Are we making high highs and high lows? Are we bullish? Low highs and low lows bearish? Breaks the structure, all these sort of things. Market structure helps us identify what is the direction, what is the market condition, and where we might want to enter within that. Really helpful for entries and specifically risk management, placing stop losses, take profit, entries, all these sort of things. And identifying if you're looking for, what type of trade are we looking for, reversal, continuation, buy or sell. So it answers those sort of questions as well. So we'll go through some basics first. The difference between bullish and bearish market structure here. So bullish market structure is defined by higher highs and higher lows, obviously making, going from the bottom left to the top right of the screen. And we tend to have breaks of structure consistently to the upside, where we also respect lows as well. So that is a simplified version of bullish market structure. Bearish is just the opposite. We're making lower highs and lower lows. We have breaks of structure to the downside. Yeah, pretty simple. In reality, it might look something a bit more like this, where it's a bit messy and you don't have clean, pushes to the upside and pullbacks as well. You might have some low time frame structure in between the high time frame or the high time frame swing points or external highs and lows here. But in general, we're still making higher lows and higher highs here as well. And then for a basic example, the same thing, we're respecting highs and we're breaking lows as well. So that's a pretty simple definition of bullish versus bearish market structure. I mean, the easiest way to have a look at this is you can use the regression trend tool here. So regression trend tool, if I just draw over this sequence of market structure, I can very clearly see that this is going to the top right. So most likely that's going to be bullish here. Vice versa, if it's going to the bottom right, that's really bearish there. So pretty simple. And so easiest ways to identify direction is to use regression trend tools. This will be kind of covered a bit later on, but there's a free indicator that you can use to help you simplify direction using some regression trends, and they're set over specific times, which will show you like low time frame, middle time frame, and high time frame market structure and direction. So that indicator is on the WOP as well, and I'll put it below the links to some of the videos. But yeah, direction is always constantly shifting through bullish or bearish across all different time frames. And so you can identify a change in direction or a shift in direction by identifying a change in highs and lows. So when we go from making higher highs and higher lows here, making higher highs and higher lows, to then breaking a high into immediately breaking a low, direction has shifted. So what we were once making higher highs, higher lows, now we've made a lower low and a lower high, and we're now pushing bearish here. So this sequence into breaking a high here, breaking a high into then breaking a low, that shifts the direction to then create that, potentially create a lower high into then pushing bearish. And that is a bearish shift in direction. For a bullish shift, it's just the opposite, where it's looking to break the low into then breaking the high here. And then you're making a new sequence of what was once lower highs and lower lows. Now you're making higher highs and higher lows. Yeah. For a actual example of a change of direction, this is, we can see the external highs and lows of this sort of structure. And then we can see we have a break of structure to the downside here. So a break over this low into then price action coming in, or volume coming in, breaking this high here, indicating a shift in the direction where we have a pullback into then higher highs being formed here. So bullish market structure. So shifting from bearish to bullish after you take out a low and then take out a high. It's pretty simple. Change in direction is defined by change in highs and lows. And then internal versus external structure. So this is kind of referring to fractal price action. In between, we'll call this like a high time frame move here. When you have a higher time frame, bullish uptrend, you can have like, low time frame uptrends within that sort of bullish trending range. And so we have a high time frame swing or push bullish here. And then once we take out this high, most likely we're going to have a pullback into then a correction. And on the lower time frame, what this will tend to look like is that you have a lower time frame shift of structure to then lower time frame shifting bullish. So low time frame was pushing bullish with the high time frame, taking out the previous high time frame high or external high. You then have low time frame after it's taken out that high, correct or pull back, will then low time frame to push bullish again with that high time frame. And so this is, we have internal structure within this external structure. So we have internal push bullish, we have an internal push bearish. And so everything in between the external highs and lows, this is all internal highs and lows. So you can have external breakthrough structure here, and then you have internal breakthrough structure here, where these aren't as significant. Internal breakthrough structure are kind of signifying a lower time frame change in direction. So we can have a breaker structure here. Doesn't mean high time frames overall bearish. We'd want to wait for a high time frame external low to be broken. So if we took out this low here, that would be more of a high time frame shift in direction. And you can even go even deeper, where you have a internal shift bullish that aligns with high time frame. Then on the internal pullback, you can have a smaller shift in direction as well. So you have external breaker structure here, and you have internal breaker structure here. And this is just kind of showing you we pushed bullish, took out the external high. The internal structure shifted bearish here, had a bit of a downtrend, and then we came into the lower half of this external push bullish, where we had internal structure then align with that high time frame, shift bullish, and continue that overall direction. For example, external highs and lows here, and then we have some internal structure shifts as well. So it's something to keep in mind. It's not the most important thing, but it's just helpful for aligning different directions of price action, different time frames. So low time frame, middle time frame, high time frame. And that kind of brings us into fractal market structure here. So fractal market structure is simply that the same patterns repeat off every different time frame. So price behaves in the same way on the 1 second, the 1 minute, and 15 minute. And so you can trade them all in the exact same way. The biggest mistake people make is this. They don't actually fully understand fractal price action. For me, I just simply do the same thing across all different durations of price action, and that massively boosts my win rate and my profitability. So if you zoom in and out, all structure looks the same. And so there is no best time frame. There's only the time frame that suits your style. So if you're looking for scalping, small little moves, you want to focus on lower time frames, maybe 1 minute, 5 seconds. If you're going for swing trades, maybe 4-hour daily would be a bit better as well. Most people think that the lower time frame is just noise, and the lower you go, the more noisy it gets. But this is simply because they're not good at understanding the difference between internal and external structure and connecting and aligning different time frames. They're not good at telling the difference between signal and noise on the low time frame. They don't understand when to take when to look at the low time frame as well, which we'll cover how to align fractal price action a bit later. So so you can have a shift within the shift. This kind of covers more fractal counter behavior, which we covered a bit earlier on. But for example, here you might have a high time frame, push bullish, then you have a pullback and another push bullish. What this will look like, you can have a middle time frame correction here, where this high time frame push bullish has a lower time frame or middle time frame, highs and lows. So you have a bearish downtrend on the middle time frame that makes up that high time frame push bullish, and then you might have a lower time frame sort of bearish impulse. So low time frame has aligned with middle time frame, then it shifts bullish, correcting that previous bearish move, coming into the upper half, and then continuing that. And you can have little shifts of low time frame changing middle time frame, which then eventually changed high time frame. So you can have shifts within shifts within shifts. For example, here, this bearish move overall, it was made up of lower time frame, highs and lows, lower highs and low lows when we're pushing bearish. Then on the pullback, we had a bit of a bullish trending range here. We're making high highs, high lows, which then we eventually took out some lows here. We had a bit of a shift bearish, which then that bearish downtrend started with lower highs and lower lows as well. And so when we look to align timeframes, we always want to start off with what is the overall move, and then where are we within that. So we can have the overall high timeframe push bullish, middle timeframe can shift bearish here. We can come into the lower half of this high timeframe move, and then we can wait for middle timeframe to shift in our favor, shift with that high timeframe, and then we can that low timeframe will probably pull back into then again do the same thing on just this middle timeframe move, and we can wait for a low time frame to shift in our favor. So waiting for middle time frame to shift bullish, low time frame to shift bullish. Once that has happened here, all time frames have shifted in our favor, and these tend to be the highest quality setups that move furthest in our direction as well. And so these are sort of the basics of market structure. What is the difference between bullish versus bearish market structure, changes in direction, internal versus external structure, and fractional market structure. This is helpful for finding direction, answering that. Should I be looking for a buy? Should I be looking for a sell? But it doesn't tell you where exactly to enter. So highs and lows tell you what direction to enter in. When you're trying to find where to enter, you don't want to enter too early. That's where we go figure that out in condition. So market conditions tells us where to enter. Direction tells us what type of trade to be taking, buy or sell. So we'll cover that in the next video as well. So condition versus direction, which is probably very, very important because if you're entering with the overall direction, but you're looking to take a buy after you've previously taken out a high, this is where, if you enter the wrong area within this move here, if you're looking for a buy here and you place your stop maybe around here, you'll just get stopped out before price goes in your favor. So if you keep getting stopped out or price action goes in your favor after you enter, it's likely because you don't understand market conditions well enough and where to enter within overall market structure and with the direction. So we'll cover that in the next video, and I'll catch you guys later.